Let's talk about market manipulation. So you have an established range, you have a swing high, a swing low. There's going to be a lot of efficient navigation of that range by market makers and by big money contingencies like banks, hedge funds, that kind of thing. So we have a lot of moving parts in this complex system, right? And if we get the kind of hand tip, the signal that we're moving in a certain direction, it doesn't mean we're going to move straight there, right? So when we mark liquidity, we are basically saying, okay, here's a big pocket of buyers or sellers that we think it's going to dip into and then rip. Basically, they hunt big stop orders. They're not hunting you and me, but if there's a large order on the tape, then the market makers have an incentive to drive price to that place and make more transactions. So that's why you'll see a lot of action around high liquidity nodes, maybe on your volume profile or something like that. TPO, if anybody uses that. But essentially, we are looking for these liquidity grabs where they're coming down or up, and they are basically sweeping stops, getting a certain percentage of the market out there, and then they are basically buying their fear or their stops. Let's talk over some key terms here. We have liquidity pools, and that is just an area where stops cluster. So maybe you have a swing low, goes up a little bit, it comes down, and it catches right around the same area, and then you come back and you're in the middle of the range. So there's two sets of stops below those two swing lows. And let's talk really quickly about why there are two sets of stops there. So each time the market kind of went down and then started to move up again, any new traders, any new longs there, they're going to say, okay, well, I'm long unless we lose this swing low, right? Unless we make a new low and then, okay, my idea is wrong, I have to reevaluate. So that's just basic risk management. Most people or most institutions will do something like that, right? So basically we're looking for areas where you would expect stops to get ran. So if you're bullish, you see relative equal lows, you want to play for a range break upside, but it's a little overextended. Maybe it's near the 0.68 fib on the range, but it's often prudent to wait for a liquidity grab, wait for a return to that liquidity pool and kind of to confirm the idea. And then I want to talk about the kill zone concept. So not as scary as it sounds. It's actually the opposite because it'll keep you safe. There are certain times where the market has really high liquidity. And by that, I mean, there's a lot of transactions happening, a lot of trading going on. And that will give us the follow through that we're expecting on the move, the clarity of the move. It's less of that, midday afternoon, lunchtime, choppy, washy, up and down. It's kind of that kind of stuff where if you have a lot of volume, you'll get follow through. And that's usually when the targets are hit. And then it's just kind of, as I would call it, garbage time in the other times. And the thing about trading is there's 24-hour markets now. You can do it in and out all day long and burn out really quick. So I'm really focused on trading the best times of the market. So we're talking about London, 2 to 5 a.m. EST. And then, what I usually trade is the New York session, and that's 8 to 11 a.m.